listen, when everyone's running, go in the opposite direction. My first mentor taught me that. And I got to tell you, there's always something bad going down somewhere, which means it's always a perfect time to invest.
A couple of years ago, when I told a friend that I was working for a real estate company, he kind of probed me a little bit about real estate and what do you do? And he's like, what are your investors doing? And we got into this weird conversation where essentially he said to me that he thought good investors would just like wait for the right interest rates. And I was like,
oh my gosh, that's really funny.
So it just surprised me because I was like, that's weird. I don't know anything about real estate, right? I'm a media guy and I worked with you in that. But I was like, none of the people that I like meet ever even give a rip about their interest rates, right? Nobody's ever like trying to time
until you become
that.
a real investor that actually invests and owns things, no one really gets or understands the game because we're not taught it. It's not part of our financial education process, by the way, which is real sad. My daughter's got thousands of dollars. My 15-year-old daughter has thousands of dollars she has sitting in her account. And I'm teaching her right now the world of investing, owning assets, buying things, crypto, moonshots inside of companies that are on the New York Stock Exchange that have a chance to really go somewhere. And that's what we should have all been taught, but we don't get it. This person clearly clueless. The idea that, the interest rate determines, whether, it's a good deal or not, or whether, I'm like, are you kidding me? It's about arbitraging interest. Who cares what the interest is? You tell me that they jack up the rates to 16% and someone's like, oh yeah, that's horribly expensive money. I agree. But you show me a safe, consistent return at 50%, I'll borrow 60% all day long, and I'll arbitrage the 34%.
So I remember at the time just being like baffled, be like, that's weird. People never talk about the interest rates at hanging out with Tyler Bennett, Brandon, Steve Earle, Kris Krohn, all these guys that were buying real estate actively. They never said anything about like, oh, we're waiting for the right interest rates.
Well, and a lot of people, the thing is non-investors have been trained as consumers to be very interest focused. Oh, so you didn't pay your car off. What's your interest on that? Ooh, you're in your savings account. Are you getting 0.1%, 0.15%? Like, it's really weird. And then this is where it gets really weird. Most investors, they buy a home first that they live in. Mm-hmm. That's actually becoming, less so today. But someone goes and they don't understand that in the financial investing market, that if you want to lend on your own primary residence, let's say that you could pick up a rate at 3%. But then you do the investment property and it's 4%. You're like, someone's ripping me off. It's a full point higher. I'm like, no duh. It's an investment property. You're not living in it. There's higher risk to the bank. They're going to charge you more interest. It's an education to really learn the game of investing in money.
So what it made me think though is it's like, okay, what are the factors, and is there ever a time that you should wait? And I'm curious to know if you have a set of standards of when it's okay to wait. Because I got to be honest,
really
Kris,
really
I don't think you wait very often.
I don't ever wait for anything.
Right. I wasn't going to say it, but if you're willing to.
First of all, this is something people don't understand. I remember when my first mentor taught me, he was a very successful investor, had made millions of dollars in real estate. He said, Kris, you have to understand that what I'm about to teach you is highly counter-cyclical. When everyone says buy, sell. When everyone says sell, buy. He said, if you can run in the opposite direction of the masses, you'll always make the most money. And I thought, that's really weird. Give me an example. Did you know that every 7 years, on average, that the stock market will tank 30%?
Yeah.
And it'll take an average of 24 months before it rebounds. Now, we are long overdue because I think we're in like our 10th or 11th year, and the stock market is going to come crashing down if it follows its very long history. So guess what happens to consumers in their confidence when the market takes a 30% dive? Everyone freaks out. Same thing earlier this year when Bitcoin dropped. Every time it dropped, you know what I did?
You bought more.
Bought more. Then when it bounced back, guess what happened?
You made a lot of money.
Daddy got rich. So when the market drops 30% and it takes an average of 18 to 24 months to bounce back, if I was ever going to do stupid S&P 500 or whatever, I'm not interested in that stuff because I don't like the single digit average gains. But can you time the market, meaning the market's just dropped by 25 or 30%? Go in and deploy, hey, I dropped $250,000 in, and then it's really weird. Now it's at $450,000 2 years later. And then I exited while everyone was riding higher gains. It means that I want to make the first profits and not the last profits. Same thing, 2008. What happened in real estate? Everyone freaked out when the real estate market dropped. So all these homes go back to the bank and everyone thinks real estate is the worst investment ever. I went into Phoenix and Vegas because they were the hardest hit markets, and I started buying thousands of homes. And sure enough, beautiful brand new homes and new subdivisions that had been selling for $340,000, I was picking up for 120 grand. Guess what
insane.
happened after 5 years after we
Bounced back.
didn't build anything? They had to come back because people keep having sex. People keep making babies. Migration, people think America's great still somehow. I don't even know how. And they keep moving in. And guess what that means? It's basically supply and demand based on population. We can only go so long without building houses. So listen, when everyone's running, go in the opposite direction. My first mentor taught me that. And I got to tell you, there's always something bad going down somewhere, which means it's always a perfect time to invest.
So 2022,
Yeah.
if the market softens, should people wait?
Dude, I got to tell you, it gave me kicks and giggles to hear Dave Ramsey answer this for one of his students. It's like, Dave, I'm just really nervous right now. I'm about to buy a property cash, the Dave Ramsey Moth method and model. And I just feel like I should wait for the market to come back down. And you know what Dave's response was?
What?
He said, all right, you'll probably be waiting a decade, and I wouldn't do that if I were you. And I'm like, oh my gosh, Dave Ramsey and I agreed on something. This is amazing.
He said that?
Someday I'm going to meet that man, and it's going to be really, really awkward because I haven't been the kindest human being. I know he's a good-intentioned, good human being that has people's financial interests, best interests in mind. And I would say for the tribe of people that don't know how to invest and don't know what they're doing, because you can't accumulate yourself to freedom. The average person just can't do it. You can't save yourself to freedom. You have to invest yourself to freedom. And getting out of debt and eliminating debt and staying debt-free and buying things cash, you're going to lose your biggest asset, time. So he and I might just always disagree, on that one little small, I think really important detail, but there you have it.
So would you ever wait?
No.
Would you ever wait to deploy capital?
Well, if I am waiting in one sector, it means that I'm not waiting in another. So I own hundreds of companies at this point in my life.
Right.
And I'm in the restaurant industry. I'm in the product industry. I'm in the tech space. I'm in the real estate space. I'm trying to be as diversified as I can because Ray Dalio says that, Ray Dalio, by the way, one of the most successful hedge fund managers of all time, has returned like $27 billion or something to investors over a 25-year period of time. The guy knows what he's doing. And he said, I actually met him live at a Tony Robbins event that I paid to be in. And in like a private club of Tony's. And
Yeah.
Ray basically said, you've got to get into a minimum of 15 different asset classes that are uncorrelated before you can eliminate almost all of your risk. Meaning every asset class in its lifetime will go down to zero.
But they're not going to all do it together.
Yeah, but they usually don't do it all together. So the goal is to be super, super diversified. So let's talk about single family real estate. Right now, we're going to see the prices over the next 5 to 7 years. Yes, these are predictions. These are not promises. These are for illustrative purposes. I am not a lawyer. I'm not giving you legal advice, and I'm not giving you any financial advice either. My opinion is that the real estate market over the course of the next 7 years is going to keep increasing in value. And at certain times, it'll do it more steadily than others. And I want to share with you a couple of reasons why this is going to happen. Number one, we're missing millions of homes. This is a number that you can track, and it basically represents the demand. Now, that 5.28 million demand that USA Today talks about is different than the pre-pandemic 2.1 million demand that Forbes and Wall Street Journal was talking about. What's the difference? We are legitimately missing now likely around 2.5, maybe even 2.8 million homes in this country. The rest that make up the 5 million, the other couple million, are people that are saying it would be convenient for me if I could to upgrade and buy a different house because I'm not planning on going back to work. It's a house to live in. It's also a house to work in. And I need that house to look different than the one that I have. That's also why remodels are super high right now because inventory is so hard to get. New builds are sometimes out 1 or 2 years. So there's a lot of frustration in the marketplace. It'll take a decade or at least 7 years to work itself out. This supply and demand crisis, historical proportions we've never seen before, will keep driving the price higher and higher and higher. But on top of that, we have a government that believes that it can just print money. And finally, we are literally getting the government, we're basically getting these new bills blocked left and right, thank goodness, because people are starting to realize, we increased the money supply 40% in the last 12 to 15 months. And guess what? Inflation jumped from 6 and 7% to 15%. It's not done, and it's going to stay for a long time. Hyperinflation technically meets the definition of a 21% devaluing of the dollar on an annual basis, and we are definitely headed in that direction. I believe we definitely will hit hyperinflation, and it's going to be here for a while, which means anyone who's betting on 401ks and IRAs and the stock market, their money is going to massively diminish, not in number, but in value, buying dollars, what you can actually get. Now we're seeing gas prices on the rise. We've got problems. And by the way, when you start sending checks like the government is doing to people, and you have a workforce that can literally eat up all unemployment, but we're still now forced at 5 or 6%, that's because the government is also printing more money just to give people, which is disincentivizing people from working. This is what a socialistic country looks like. I lived in one for 2 years when I lived in Europe and in the Eastern Bloc of Germany. And I want to tell you, this is not going to bode well for the happiness of the people if we keep moving in this direction. It does have me concerned. I tangented. Where were we going? Does that mean there's still opportunity? Yes, there's still opportunity everywhere.
Well, that's what I was going to ask, because it seems like to me, Kris, that market timing...
No. I remember where I was going, bro. Real quick.
Okay.
So single family homes,
Right.
what happens in 7 years if they come crashing down?
Right.
If they come crashing down, first of all, you'll know it before it happens because it's not rocket science. It's just supply demand. When we need less than 500,000 homes based on demand, you're going to see me liquidating like a madman. And then there's going to be this funny gap where you're like, Kris Krohn, what are you doing? And I will have found another market to go in that will be insulated from market drop. And I'll also probably be more in some of my other diversified projects. And then the market's going to tank. And then I'm going to re-enter the market like a beast. And we are going to be buying tens of thousands of properties. It's going to be incredible. For about 3 years, there will be very little competition. People will think real estate is the worst thing ever. They'll think it's the riskiest thing to do, and the prices will go back to below what the national median should have been, and we'll buy up the most beautiful real estate at the most beautiful prices, and people still need a place to live, and we're going to love every single step of that journey.
So you believe that you can win regardless of what the market is doing?
Yeah, I've been playing the game almost for 20 years now. And we saw the Great Recession, and I think what we're going to see in 7 to 10 years is going to make the Great Recession look cute, and I'm excited for it.
Well, knock on wood.
No need.
You know, we have a joint friend of ours, whose father in '08 saw the value of his home plummet, so he panicked and sold.
Wish I knew what firm we're talking about.
I'll tell you after this.
Okay, great.
I'm protecting the innocent.
Okay.
What do you think of that strategy? Why would someone do that?
So it's really weird. You make your money when you buy real estate. You only realize a profit when you sell real estate. And if you have to sell it at a loss, hey, dummy, don't do that. Here's where what I just said is not going to work. I buy, even though the national median is now creeping up to 400,000, we'll go buy that. You're getting people that are buying $400,000 and $500,000, $600,000 homes as investment deals. And I'm like, you are going to get spanked. Just give it time. You're going to get spanked so hard. You're going to gain more on appreciation dollar for dollar based on the value price that you're entering in. But when it comes down, you're going to get spanked, because watch what happens. If I specialize in buying a $220,000 house while everything else is selling for $300,000 and $400,000, and the market corrects, and I'm insulated from that correction, I'm going to hold the property even if I'm underwater, and I'm just going to rent it out. And people don't understand that if you you buy $1 million house at a really good deal, it's worth $2 million, and you buy it for $1 million. When you rent it out, you can't rent it out positively. You can do that Airbnb in certain markets if it's a short-term rental, but as a standard rental, you would lose an average of $3,000 to $5,000 a month. There is a point of diminishing return and then loss. And so, for example, if you buy a $200,000 home, you're going to get your highest cash on cash. Once you approach right now somewhere around $300,000 to $360,000, you cross the barrier where if you buy the house in that price range, you can't rent it profitably. You're going to lose money. So I have a rule. I don't buy anything near the median because I want really good cash on cash. So if the market turns, I'm insulated. My homes don't go down nearly as much, and I can rent them and keep making money in the meantime, and I keep getting the tax benefit. Anyone that is buying at or above the median, when the market corrects, they'll say, well, I either give it back to the bank or I rent it at a loss. They're going to give it back to the bank.
So, correct me if I'm wrong. The value of a home really only matters at the point of sale.
It does. Yep.
So if you were living in a home and they come to you and they're like, your home just lost 50% of its value, and you still have a job and you can still pay the same rent because your mortgage isn't going to change just because the value changes, as long as you don't refinance
Dude, this is
it.
what happened to me in '08. I
Right.
had this
You
$2 million house that
just
went down to
ride.
$1 million in value.
But you didn't care because you're living
Oh,
in
I'm
it.
living in it. It's my house. Like what, the people are weird. It's gone down in value. Hurry and sell it and take a loss because they're
It's like, just
thinking
ride through
it's
it.
going to get worse and they don't want to get caught. And I'm like, you just did. You can only realize a loss if you sell. Super bizarre. Weird thing is, bank came back to me and they said, hey, we're afraid that you might give this house back to the bank. So we would like to refinance this house under 2%. I'm like, you want to cut my payment in half? Okay. Like they restructured the loan for me. I didn't ask for it. I didn't need it.
They
I
just
wasn't going to give
assumed
the house
that-
back to the bank.
Right.
And I don't buy investment properties that you have to give back when the market downturns. The only people
Okay.
that have to do that are the people that are over leveraged or their price point is over the median.
Gotcha. And that's how you stay insulated from whether the market's going
Because
up
as long
or
as
down.
you can rent profitably, why would you realize a loss by selling?
Yeah.
Well, $500,000 house. Everything worked while it was going up in value, but when it went down and rents couldn't keep up, and you're writing a $1,200 check for the difference every single month, you can only do that so long before you say, I fold.
Yeah.
I give up.
Gotcha.
Here you go, bank. And the bank says, well, we don't want this. Let's just sell it for 220 grand. Here I come. I'll take your $500,000 house for 220 grand.
So how are you able to do this when a lot of investors aren't?
Like I said, over leveraged, over committed, and
But why
inexperienced.
don't you get over leveraged?
I have rules. Wealth for me, wealth is a system. And if you play by the rules will always work in your favor. Did I remember when I was at the beginning of my game of real estate investing, and I was buying all these $150,000, $200,000 houses. And a buddy of mine said, dude, you realize that all these guys over here are making fun of you because they're buying these $1 million houses that are worth $2 million. They buy a house and they get the equivalent of equity of what you get on 15 of these little tiny guys, maybe 20. And the next year when the market bottomed out, they went bankrupt. They lost everything. All their houses went back. And I just kept renting the houses and making money. I'm like, that's why.
Yeah, and again, that
So I do have a certain level of value for safety.
Gotcha.
And there's an ROI that I target, and I need that ROI to work in up and down markets. Single family homes will always be in demand. They will always be needed. And if you have the nicer ones on the right side of the railroad tracks in the nicest growing markets that have steady and improving job growth, companies moving there, people are migrating, their population is increasing, then guess what's going to recover first? That's why Phoenix and Vegas recovered so fast. That's why I made my investors over $100 million just in those first 5 years. You show me a tragedy, it's not a tragedy. That's what the media will paint that picture as. We saw pre-pandemic in over a 20-month period of time that the number of millionaires in the world increased 10%. The media reports on jobs lost and woes and everyone upset and people financially losing left and right. We saw one of the greatest booms in wealth creation ever. Mm-hmm. People are confused. Everything is different than it seems usually financially. It's counter-cyclical.
It's interesting. Kris, you have so many people that come and join you as partners and go to these markets where you can get homes below the median.
Yeah.
Do they know that this is why your strategy works?
I don't know. I mean, I know that they know that I've done thousands of deals. I've done over $1 billion
Right,
in transactions. I think they look at the track record. My experience is a lot of investors do actually ask me about market insulation and protection. And once they see our strategy and what we're doing, they get it. You're going to have to take a risk. This is the risk that certainly makes the most sense. And every time the market's turned, it's ended up being really, really good. I'm really grateful for '08. It was, for many companies, it was a refiner's fire. A lot of people died. A lot of people hibernated. We thrived. We grew. It was awesome. So you need a strategy that works great in a normal market, but it works even better in a bad market. And I value that. That's important to me because I don't like feast and famine. I don't like 8 years of growth and then 3 years of desolation. At the end of the day, I function on a strategy that meets 6 core needs. Mm-hmm. It has to be profitable, duh. But it also has to require the least time and effort. It also has to require the least risk, comparatively speaking. It's got to work in up and down markets, and it's got to provide a valuable service that people want. It's got to create value. And that's what this strategy is. Buying single family homes, short-term buy and hold. So I've got people all over the world, they'll go to all of my links in bio and they'll get this document right here. It's called Krohn Consortium. And I publish my findings on my last several thousand deals, addresses that I've done. I share all of my strategies. And based on that, people will say, okay, like, dude, let's partner up. Let's start a company together. They'll fund it. They'll put some money in. And then my team of 200 experts will go into the markets and buy the best deals. And frankly, if the market goes down, I get more excited.
So I know the inventory across the world and in America is low, and things have just gotten more competitive.
Oh yeah, we've had to work.
Do you have room for more partners?
I'm definitely accepting applications on new partners, but we are definitely being more careful. In, I need partners that are excited about the market. They've educated themselves. They've watched my videos and maybe read my books, and they're ready to take on the risks. They're ready to invest. And they have to have the right mindset. You know, I always tell my partners in the first year, you got to come to one of my mindset training events so I can teach you how to change your mind to adapt to making millions of dollars. Dude, look at when you got started. How many years ago did you buy your first property?
4.
How many?
4.
4 years ago. And let me ask you, you bought one property. How many properties do you have today?
We just closed on one. We're under contract on another, and we're looking at a third. So we turned that 1 into 3.
Yeah. So right now you're seeing a lot of really, really great
Which
growth
isn't
in a very short period of time.
which isn't including my primary residence that has a basement apartment still that we were able to do from the cash flow of the first home.
So now fast forward, where do you think you'll be in 10 years?
10 homes?
You're probably going to be 10 or more homes. At some point, you're going to hit the hockey stick escalation.
Where it just snowballs.
And 10 becomes 20 and 40. And, by the time you want to retire, you're young. By the time you want to retire, you will have a massive portfolio of real estate. You could literally condense and make a bunch of them paid off, go for really, really high cash flow, still get great growth on that. Super smart.
Yeah, I love it. How can, if someone's liking this strategy, which, by the way, I've heard you talk about those 6 things many, many times, but I don't think I've ever seen it in the light like I'm seeing it today.
Yeah, so I've written a book. I've written a couple of things, 5 books. This one's called The Straight Path to Real Estate Wealth. Any link in bio, you can actually, you can see that you can get that book for free. Krohn Consortium is my track record for people that want to partner with me. I just think people should check out more social media and click on the links and talk till they finally get to a member of my team and say, tell me about partnering.
I think I have a shortcut for you if they want to talk about partnering, because you can hit kriskrohn.com or, like you said, check out YouTube videos. But for those that are just listening, jot down this number, 385-217-3477, and just say, hey, I'm interested in buying real estate. I want to partner. It's a text, so go ahead and text that number. And Kris, you respond to these messages yourself. And then put them in touch with a member of our team. Is that right?
Yep.
Awesome. So again, that number is 385-217-3477. Text Kris. Say you want to partner.
And if I could literally just give a last piece of advice, beware of fake confusion. If you're watching more than 10 minutes of media a day, of news, it's probably too much. You got to be careful. There's 2 main media outlets, and one represents the left and one represents the right, and they're both knuckleheads to some extent. And you got to make sure that you're sourcing the right kind of information, because media in general is really just going to tell you how bad everything is. Meanwhile, the wealthy, like myself, are just getting richer, and it's because you got to find a different data point for accessing knowledge and information. Mentoring with people that are like me in my field and space will definitely give you a very, very different perspective than the media. And everyone should have mentors in their life. If you don't have 1, 2, or 3 people that you're paying to financially help you see the world differently, more successfully, and making better options and choices with your own money, setting money aside and investing, you're probably limiting yourself. We all went to college at one point, or we all went and got some kind of formal education so that we could do our career. You need to get some formal education and investing, and that usually shows up with a mentor or in a mastermind, and or a live financial event, because you don't have to read books to become really knowledgeable on this. It's actually very little information to really learn how to get in the game effectively. There's great books that Tony Robbins put out, Money Master the Game. I've written my financial books. You should be consuming those. You should be working with some type of mentor, and you should be getting exposure to this counter-cyclical thinking.